Welcome back to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting through all the market noise and weakness. Today, we are putting Rivian directly under the microscope. The company just dropped its Q4 and full year 2025 earnings report. And if you just glance at the headlines, it looks great. A beat on revenue, a beat on earnings. On the surface, it looks like they are building a financial fortress. But you know our job here. We're going to stress test the walls. We're going to inspect the foundation. We are here to figure out if this structure is actually built to last, or if it's all just a hollow facade. All right, let's get to work. Whoa, hold on a second. Before we start admiring the steel beams and the concrete, we have got to frame this whole conversation with the right amount of risk. And this quote right here from Mumu, it just cuts right to the bone. Every single number we are about to break down, the good, the bad, and the ugly, is being filtered through one single lens by the market. And that lens is the R2. This is not just another car they're launching. You have to understand, this is the central pillar that the entire investment thesis is resting on. So while we dig into these numbers, you have to keep this warning shot in the back of your mind. The stakes here, they're incredibly high. Exactly right. And this slide just lays out the conflict perfectly. Over on the left, you've got the simple headlines. This is what the trading algorithms see, what the casual investor reads. Revenue beat, EPS beat. Looks like a clean win, right? But on the right, that's the real question. That's the iron financial question. What is really going on under the hood of this company? Because when you look at this report, you're looking at a tale of two completely different companies, aren't you? One is this amazing high-margin software business that's growing like a weed, and the other is a struggling car manufacturer with some seriously declining numbers. So our mission in this explainer is to pull these two stories apart, figure out what's real, and forge a clear verdict on which one is actually writing Rivian's future. All right, let's build the bull case. If you're going to put your capital into Rivian, you need a foundation of hard, undeniable facts to stand on. We're not talking about hype. We're not talking about speculation. We're going to look at the actual load-bearing walls of this company's financial structure. And I'll tell you, there are some genuinely powerful numbers in this report, numbers that suggest Rivian is really forging a path to long-term profit and stability. So let's start with the big one, the most important one. This number right here is the absolute bedrock of the entire bull argument. I mean, the scale of this turnaround is just staggering. Think about it. For the entire year of 2024, Rivian had a gross loss of $1.2 billion. Let me say that again because it's insane. For every dollar of stuff they sold, they were losing a huge chunk of money just making it. It was a fundamentally broken business model. But then in 2025, they did a complete 180. They flipped that script and swung all the way to a positive gross profit of $144 million. That is a $1.3 billion swing in a single calendar year. This isn't just tweaking the numbers. It's a monumental shift that proves, at the very least, that this company can actually make money on the things it sells. Okay, that is impressive, I'll grant you. But you can't build a fortress on a single pillar. What in the world is powering such an incredible turnaround? And this table shows you the engine behind that profit swing. Now look at this carefully because it tells a fascinating story. The automotive revenue, their core business of selling trucks and SUVs, it actually went down by 15% year over year. Now, if you stopped reading there, you'd think this was a total disaster. But then look at that second row. Software and services revenue absolutely exploded. It grew by 222% to over $1.5 billion. This is almost all coming from their big joint venture with Volkswagen, where Rivian is basically selling its EV platform and its software. This is the heavy lifting. They are transforming from being just a car company into a technology platform. And here's the critical part. This software revenue, it comes with way higher gross margins than building cars. They are literally building a new, much stronger financial pillar for the whole company. But hang on, is that a sign of real strength, or is it a brilliant way to cover up weakness in the main business? I mean, let's be real. Are they just putting a positive spin on the fact that car sales are actually falling? That's the million-dollar question, isn't it? But RJ Scringe's quote here frames it as a deliberate strategy. He says 2025 was all about laying the foundation. The bulls will tell you this is not an accident. They're strategically using the high-margin, capital-light software business to fund the incredibly expensive scaling of the automotive side. Think about it. They're using the Volkswagen deal like scaffolding while they build out the main structure, the whole R2 platform. It's a calculated choice to fortify the company's financial base before they make their next big push. And this right here is the final crucial piece of the bull case, the knockout punch. After everything is said and done, after all the spending and investment, the company is sitting on a massive war chest of over $6 billion in cash and other liquid investments. In the brutal, capital-intensive world of making cars, cash is oxygen. This isn't just a number on a spreadsheet. It's a runway. It's the financial firepower they need to launch the R2, to survive any production hiccups, and to absorb the operational losses that we know are still coming. So the bull case ends here. Rivian has proven it can be gross profitable, it's built a brand new high-margin revenue engine, and it has the cash in the bank to finish the job. From this angle, that fortress looks pretty darn solid. All right, that's a compelling argument. I'll give the bulls that. The foundation seems stronger than last year. That new revenue pillar is impressive. And yeah, they have a mountain of cash, but no fortress is invincible. And now we have to do our job. We need to walk the perimeter of this thing and start looking for the cracks. We need to find the stress fractures that could bring the whole thing tumbling down, because I promise you, for every strong number in this report, there is a deeply concerning counterpoint. Let's start probing for those weaknesses. And the first, most obvious crack is right here. It doesn't take a magnifying glass to see this one. For all the fancy talk about software and platforms, Rivian is, at its heart, a car company. And in 2025, they delivered fewer cars than they did in 2024. That's a drop of almost 18%. A growth company is supposed to grow. Seeing your number one operational metric go backwards is a massive red flag. This isn't some little dip, it's a significant reversal of their core function. You can't claim you're building a scaling business if you're selling fewer of your main products. This immediately calls the entire growth story into question. And if that full-year delivery number was a crack, this right here is a gaping hole in the wall. The fourth quarter is supposed to be the strong season for automakers, right? Holiday sales and all that. Yet Rivian's Q4 automotive revenue didn't just dip, it completely collapsed. It was cut almost in half year over year. It fell from $1.52 billion in 2024 down to just $839 million in 2025. I mean, that drop is absolutely breathtaking. It shows that the weakness in deliveries got worse, not better, as the year went on. The problem isn't getting fixed, it looks like it's accelerating. This is not a soft quarter. It's a sign of a major structural problem in their primary market. So the big question is, why is this happening? Well, the company gives three main reasons in their report. First, they lost $270 million in regulatory credit sales. This was basically free money, pure profit, and poof, it's gone. Second, they're blaming lower demand because the federal EV tax credits expired for their vehicles, which is really just a nice way of saying their pricing might not be competitive without a government handout. Exactly. And third, a lower average sales price because they sold more of their commercial delivery vans, which are cheaper. A bear would look at this list and say, these are not temporary problems. These are serious, ongoing headwinds. They're losing a key source of revenue, they're facing price pressure, and they're dealing with shaky demand. Now, before we get to what is, frankly, the most frightening part of the bear case, we need to quickly define a key term you'll see, adjusted EBITDA. Now, companies love to use this to show their core operational profitability. Forget all the accounting jargon. In simple terms, it's the best proxy we have for cash flow from the main business. A positive number means the business is generating cash. A negative number means it's burning cash. And for a company like Rivian, this is the single best metric we have for how quickly they're lighting that $6 billion war chest on fire. And there it is. For the coming year, 2026, Rivian is guiding for an adjusted EBITDA loss of between $1.8 and $2.1 billion. Let's just use the worst case number to be safe, negative $2.1 billion. This is the speed of the cash burn. So that $6 billion fortress of cash we were so impressed by, at this rate, it only lasts about 3 years. And that is assuming absolutely nothing else goes wrong. The bear case is brutally simple. Yeah, the gross profit turnaround is fantastic, but the company is still incinerating cash at a completely unsustainable rate. The clock is ticking, and that $6 billion runway is suddenly looking a whole lot shorter. So here we are. We have two completely opposing forces at war inside this one company. You have a bull case, and it's built on a truly incredible gross profit turnaround, a booming software business, and a huge pile of cash. But then you have a bear case, built on shrinking car sales, weakening demand, and a massive, terrifying cash burn. The entire structure of this company is under tension, and it all rests on a single critical point, a single piece of engineering that has to carry the full weight of both the bull's hopes and the bear's fears. And that, of course, is the R2. And this is really the ultimate question for anyone looking to invest. Is this vehicle a real silver bullet? Can a single product that isn't even out yet solve all of these deep-seated problems? Can it by itself reverse the decline in deliveries, justify burning $2 billion a year in cash, and somehow build a bridge for the company to get to sustainable profitability? The market seems to be betting that it can, but the pressure on this one vehicle is just immense. It has to be a home run. I'm not talking a single or a double. This thing has to be a grand slam. Anything less, and that bear case starts to look a whole lot more convincing. To be fair, you have to give them credit. The news flow leading up to this launch has been incredibly well managed. This timeline shows a steady drumbeat of positive execution. Back in December, they showed off their own in-house autonomy chip and AI platform. Then in January, the R2 officially went into final testing. People spotted it out on the streets. Just this month, they let the media drive some of the pre-production models, and the early buzz has been really, really positive. And it's all building up to the full reveal next month. Yeah, they have masterfully built the anticipation. They've played this pre-launch phase absolutely perfectly, which, frankly, is a major reason the stock has held up as well as it has, despite those awful automotive numbers. But let's connect all this hype back to the cold, hard numbers. The R2 is not just a cool new car. It's the absolute linchpin of their entire financial plan for 2026. First, it's the only prayer they have of hitting that ambitious delivery guidance of 62 to 67,000 vehicles. Second, it's aimed squarely at the Tesla Model Y, which is only the best-selling car on the planet, so no pressure there. Third, the volume and the profit margins from this vehicle are the only things that could possibly justify burning through $2 billion this year. And finally, this brings us all the way back to that warning quote we started with. Any delay, any little hint that production is slipping could absolutely shatter market confidence and make every single fear from the bear case come true. It is a single point of failure for the entire enterprise. So after stress testing the bull case and validating the fears of the bear case, we finally arrive at the verdict. How do we forge a coherent investment thesis out of data that is so deeply in conflict with itself? Yeah, when it all comes down to it, is Rivian a golden opportunity to get in on the ground floor of a massive turnaround story? Or is it a classic value trap, a crumbling facade that looks good from a distance but is completely rotten at its core? Let's put the two sides head to head one last time. So it all comes down to this slide. This is the whole story. On the left side, you have the foundation. These are the undeniable strengths we've identified. The company is now gross profit positive. Their software revenue is absolutely booming and providing a high margin floor. And they are armed to the teeth with over $6 billion in cash. This is the company you want to invest in. But on the right side, you have the fault lines, the undeniable weaknesses. Their core auto business is shrinking, they are burning through cash at a terrifying rate, and the entire fate of the company is completely dependent on the flawless execution of one single new product. An investment in Rivian today is nothing more than a direct bet that the foundation on the left is strong enough to withstand the pressure from the fault lines on the right. So here it is, the iron financial verdict. Rivian, in its current state, is not a stable, blue-chip, foundational asset for a conservative portfolio. You do not buy this stock for its stability or because you're expecting a dividend. That's not what this is. What it is a pure, high-risk, high-reward turnaround play. The investment thesis here is completely binary. Either the R2 is a massive runaway success that justifies the cash burn and propels the company into the next tier of automakers, or it stumbles and the company's financial position deteriorates, and it deteriorates fast. You're not buying a finished fortress, you are funding its construction, and you are betting everything that the blueprints are sound and the construction crew can deliver on time and on budget. Ultimately, that brings us to the one final question that you, the investor, have to ask yourself. There is absolutely no doubt that Rivian is forging a new path. They're trying to blend high-tech software with rugged, extremely desirable hardware. The vision is compelling, you can't deny it. But vision doesn't pay the bills. And with a burn rate of $2 billion a year and a core business that's shrinking, are they truly building the future of electric vehicles? Or are they just building on borrowed time, locked in a desperate race against the clock to get the R2 to market before that $6 billion war chest finally runs dry? That's the question you have to answer before putting your capital to work. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.